Let's move forward and welcome on board the first management on the show. We have with us Mr. Anush Raghavan, the President, Cash Management, CMS Info Systems, joining us on the show. Hi, good to be speaking with you. Thanks so much for making time and speaking with us. Well, healthy revenue growth is what you have delivered despite a seasonally weak quarter, though the margin have slipped a bit. Talk to us about what the performance was like in Q1. As per you, what's the tailwind, headwind, what kind of market share gains have you made in the quarter?
I think it's been another strong performance by the CMS team in this quarter. On the back of having grown 20% revenue last 3 years and 25% in profits, we managed to deliver another quarter of 17% revenue growth and 13% PAT growth. Both our businesses performed extremely well. The managed services business has grown by almost 30% and the cash business has grown by 10%. It has been, it's usually a weak quarter, the first quarter, and it has been further exacerbated by the longer election cycle and heat waves, as you have been reading about this from multiple other companies' results. But I think we feel particularly good about our performance.
Right. So can we assume that you are on track to be achieving your FY25 revenue guidance of 2,500 to 2,700 crore on revenues?
Absolutely. So about 4 years back, I think in FY21, we had given this guidance at the time of coming to the IPO that we intend to aim and double our revenues from 1,300 crores to a range of 2,500 to 2,700 crores. Last year, we upped the guidance to indicate that with our strong performance, we expect to be in the upper end of that band. As we speak, we feel fairly confident of achieving revenues of between 2,600 to 2,700 crores, which puts us in a revenue range of about 15 to 19% for this year.
Okay, that's interesting. But what about the managed service and tech solution vertical? How's the order info pipeline shaping up there in the coming quarters? What kind of visibility do you have on further wins?
As we may have shared in our interaction last time, we had a particularly solid year in FY24. We had wins of 1,950 crores, which is double of almost what we've done in any of the previous years. So a very strong performance and order book, which we were able to win last year. Most of that order book will get executed in FY25 as we've guided. In the first quarter, we've had wins of about 200 crores compared to 150 crores last year. Most of this order win has come from our remote monitoring AIoT business. We've been very excited about a large order that we won in that business, which is sort of almost a one of its kind in the country and the first for CMS, wherein we work with a very large bank to transform the entire command center and create an on-prem solution, integrate 3,000 branches and develop as many as 10 use cases of AI-based solutions for them.
Anush, let's talk about your Capex. 99 crore Capex was done in FY24. Take us the plan which you lined up for the new year for FY25.
We broadly guided that on a long-term average, our annual Capex should be in the range of about 250 crores. The previous 2 years, FY22 and FY23, we were in that ballpark. FY24, because of delays in the execution of certain orders and rollover of these executions, our Capex spilled from FY24 to FY25. So we think FY25 will have a Capex of about 375 crores. But when you look at 24 and 25 together, it will be back to the long-term average of about 250 crores.
But the business is fairly commoditized in that sense and a lot of competition, right? So we understand that the company has been focusing on diversification and ramp up of the non-cash transaction business. How's that shaping up exactly and what are the medium-term growth drivers there?
Absolutely. So, again, as part of our longer-term revenue guidance, we had indicated that by end of FY25, we believe that the non-cash parts of the business, especially the managed services and the technology services business, with a faster growth base, should contribute as much as 40% of our overall revenues. We were, in fact, ahead of the curve in that journey. In FY24, these businesses contributed as much as 39% of revenue. With some of the investments that we've been making in the newest business around remote monitoring and AIoT, which only started 3 years back, has already crossed 100 crores of revenues last year. And with some of these large order wins that we're now talking about, we expect that that business should deliver growth of between 30 to 35% CAGR over the next 3 to 4 years. And that should grow from what is today a 5% revenue contribution to a 7 to 8% revenue contribution. Further, we've also been incubating a couple of newer businesses. The debt management business, where we work with the banks and help improve the efficiency and collection efficiency of the banks, is something that we're particularly excited about. That is in various stages of pilots through last year and through this year. And over the next few quarters, we are evaluating acquisition opportunities in that business to help give us a step increase in revenues there. Further, we're also looking at B2B fintech and incremental acquisition opportunities in the RMS and AIoT space.
Anush, what is your assessment on the fintech space in India at this point in time, and you're also looking at inorganic growth opportunities in that part of your business?
Absolutely. So I think, we've had a strong history of acquisitions over the last 10, 12 years. We've done close to about 7 to 8 acquisitions, a combination of certain transformational deals and certain tuck-in and bolt-on acquisitions. We've broadly guided to our investors that for CMS, with a very strong growth rate of new order wins and a right to win, acquisitions is mostly a route for us to acquire new capabilities and enter new sectors. So basis that philosophy, we are looking at acquisitions in debt management, in the RMS and AIoT space, and opportunities around the B2B fintech space.
Okay, thanks so much for making time and speaking with us today.
If you like this video, then like, share and subscribe to ET Now.